Have you ever wondered how ordinary people grow their money without becoming stock market experts? What if you could invest in companies like Apple, Microsoft, Google, Reliance, or Tata, even if you don't know how to pick winning stocks? That's exactly where mutual funds come in. If you've heard terms like SIP, NAV, equity fund, or debt fund and felt confused, don't worry. By the end of this video, you'll understand what a mutual fund is, how mutual funds actually work, why millions of people invest in them, their advantages and risks, and how you can start investing, even with a small amount. Let's make mutual funds incredibly simple. What is a mutual fund? Imagine this. 10 friends decide to go on a vacation together. Instead of everyone planning separately, they pool their money and hire an experienced travel planner who manages everything: hotels, transport, food, and sightseeing. Each friend contributes money. The planner uses the combined amount to create the best possible trip. A mutual fund works in exactly the same way. Thousands or even millions of investors pool their money together. This money is managed by professional investment experts called fund managers. The fund manager invests this money into assets like A, stocks, bonds, government securities, gold, or a combination of these. Instead of buying just one stock, you instantly own a small portion of many different investments. That's why mutual funds are considered one of the easiest ways to invest. Why were mutual funds created? Let's be honest. Choosing the right stocks isn't easy. You need to study financial statements, follow market news, analyze company performance, monitor investments regularly. Most people simply don't have the time or expertise. Mutual funds solve this problem. Professional fund managers do the research for you. Their job is to continuously monitor the market and make investment decisions on behalf of investors. You still own your investment. They simply manage it professionally. How does a mutual fund work? Let's understand this with a simple example. Suppose 1,000 people each invest $100. The mutual fund now has $100, $1,000. The fund manager doesn't keep the money sitting in a bank account. Instead, they invest it across different assets. For example, 30% in technology companies, 25% in banking, 20% in healthcare, 15% in manufacturing, 10% in cash or bonds. If these investments grow in value, the mutual fund's total value also increases. Your investment grows because you own units of that fund. The value of these units is called the net asset value, or NAV. Think of NAV as the price of one unit of a mutual fund. If the investments perform well, the NAV usually increases. If markets decline, the NAV can fall. Understanding diversification. One of the biggest advantages of mutual funds is diversification. Imagine investing all your money in just one company. If that company performs badly, you could lose a significant amount. Now imagine your money is spread across 100 different companies. Even if one company struggles, others may perform well. This reduces overall risk. It's similar to carrying multiple backup batteries instead of relying on just one. Diversification doesn't eliminate risk completely, but it helps reduce the impact of any single investment performing poorly. Types of mutual funds. Not all mutual funds are the same. Let's look at the main categories. Equity mutual funds. These primarily invest in company shares, potentially higher returns over the long term. However, they also experience greater short-term fluctuations. Best suited for long-term investors. Debt mutual funds. These invest in government bonds, corporate bonds, treasury securities. They generally have lower risk than equity funds. Returns are usually more stable, although often lower than equity funds. Suitable for conservative investors. Hybrid mutual funds. These combine stocks, bonds. They aim to balance growth with stability. A good option for beginners who want moderate risk. Index funds. These simply copy a market index like TOR, S&P 500, Nifty 50, Sensex. Instead of trying to beat the market, they aim to match its performance. Because they require less active management, they usually have lower costs. Many experienced investors prefer index funds for long-term investing. What is SIP? One of the easiest ways to invest in mutual funds is through a systematic investment plan, commonly called an SIP. Instead of investing a large amount all at once, you invest a fixed amount regularly. For example, $20 every month, $50 every month, $100 every month. This creates discipline. When prices are low, you buy more units. When prices are high, you buy fewer units. Over time, this averages out your purchase cost. This approach is known as rupee cost averaging or dollar cost averaging, depending on your country. It's one of the reasons SIP investing is so popular. Benefits of mutual funds. Let's quickly summarize the advantages. Professional management experts make investment decisions. Diversification. Your money is spread across many investments. Easy to start. Many mutual funds allow investments with relatively small amounts. Liquidity. Most open-ended mutual funds allow you to redeem your investment when needed. Transparency. Fund performance is regularly published. Convenience. You can invest online within minutes. Risks you should know. Although mutual funds are popular, they're not risk-free. Markets can rise. Markets can also fall. If the stock market declines, equity mutual funds may temporarily lose value. Past performance never guarantees future returns. There are also management fees known as the expense ratio, which slightly reduce your overall returns. The biggest mistake many beginners make is expecting guaranteed profits. Mutual funds are designed for long-term wealth creation, not overnight success. Who should invest in mutual funds? Mutual funds can be suitable for students starting their financial journey, young professionals building long-term wealth, busy individuals who don't have time to research stocks, families saving for future goals, retirement planners. Even experienced investors often include mutual funds as part of a diversified portfolio. Beginner tips. Before investing, if you're just starting, keep these tips in mind. Invest only money you won't need immediately. Set clear financial goals. Start with small monthly investments. Stay invested for the long term. Avoid panic during market corrections. Review your investments periodically. And most importantly, never invest simply because someone on social media claims a fund will double your money. Always understand what you're investing in. Let's quickly recap. A mutual fund pools money from many investors. Professional fund managers invest that money across different assets. This gives you diversification, professional management, and an easy way to start investing. Whether your goal is buying a house, funding your child's education, building retirement savings, or simply growing your wealth, mutual funds can be a valuable part of your financial journey. Remember, successful investing isn't about finding the perfect fund. It's about starting early, staying consistent, and remaining patient over the long term. If this video helped you finally understand mutual funds, give it a thumbs up and share it with someone who wants to start investing but doesn't know where to begin. Subscribe to BNR Universe for easy-to-understand videos on investing, personal finance, stock market basics, and wealth-building strategies. What topic would you like us to explain next? Leave your suggestion in the comments below. Thanks for watching, and we'll see you in the next video.